Hi, everybody. Thanks, Cheryl, Sundeep, and all of our amazing guests today. I'm going to chat a little bit about the deal structures on Republic that also apply somewhat to angel investing more broadly and give you a sense of how the platform works in that way. And as Cheryl said, I'm the head of the investment team and biz dev for the platform. I'll share my screen and jump in. So if we, one of the ways that, so we think about, we have different types of offerings on the platform for all different types of companies, and they kind of mirror the way that the angel investing ecosystem works as a whole. At the top level on the platform, there are some important deal terms that are good to know when you're looking at Republic campaigns. So for one, it's the funding goal. The minimum amount that a company has to raise to be successful, and the maximum amount that they're willing to raise, the investment amounts that the company is looking for individuals to invest at. So typically it's $50 or $100, but sometimes it goes up to $250 for the minimum amount, and the maximum amount tends to be the max allowable by law, which is $107,000. A couple notes on timeline. So there's a start date to the campaign and an end date, and companies have it open for that amount of time. Sometimes they extend it, sometimes they close early, and investors, that's the period of time that they can invest in. The companies sometimes close on investments during the campaign to be able to withdraw funds. And there's usually a cancellation deadline for the last day that investors can cancel before the end of the campaign. So definitely keep an eye out for that. The other piece that I'm going to run through are the different terms and types of securities or deals that we do on the platform for different kinds of companies. So we do safes, we do stock and C corps, we do membership units in LLCs. Stock and membership units are both one form of equity. We can do convertible notes, and we also do revenue share. So the first one, and the most common one that we use, is called a safe. Ours, the Republic safe, is called a crowd safe. We had securities attorneys come up with it in-house. It means simple agreement for future equity. So it's Y Combinator's, and ours is modeled after Y Combinator safe. But applied to the crowd. So basically what a safe is a way for investors to have the economic effect of owning equity shares in a company without the operational burden. So investors using a safe will have, so companies using the safe on the Republic platform, the most common instrument, will pick two key terms. So the first being the valuation cap, which is the maximum valuation at which their security will convert to equity, which is almost kind of a fancy way of thinking about what the valuation is that they're investing in, and gives them that upside potential. So if a company is raising at a $10 million valuation cap, and the company exits for $100 million, and they haven't raised, and so either is acquired or IPOs at $100 million, and that company hasn't raised further equity financing, you can assume that the investor is making around a 10x return. You divide the exit valuation by the valuation cap. That's not a perfect way to think about it, but it kind of gives you directionally the way that the investor makes a return. The second term that's important is called a discount. So this is different than investing in shares or equity in a company, insofar as investors will get their equity at a trigger event. So an acquisition or a merger or an IPO or a sale of assets or a subsequent equity financing, they convert to equity at a 20% discount to the share price in that round. Usually so depending on what the discount provision stipulates for any given campaign. So for most companies, that's 10, 15, or 20%, and that's basically downside protection. So the valuation cap gives you upside potential, and the discount provision gives you downside protection. So what it says is, hey, you're investing at this early stage. One way that we're going to make this investment work for you as an investor is if we don't raise at a higher valuation than the valuation cap, then you receive your shares at a discount to what the share price is in that round. And so that's our most common instrument. It's very investor friendly insofar as it's convertible and there's a discount provision, but it's also really company friendly and allows really high quality companies to open up the investment opportunity to retail investors where they may not be able to otherwise. So it's operationally simple, gives you access to the upside and the economics of the upside while keeping it super simple. So what kinds of companies use a crowd safe on the platform? So it's usually high growth and early stage startups for the most part. So this kind of convertible instrument makes sense for companies that are gunning for an exit. So they're looking to be acquired or they're looking to IPO, and that's how the investor is going to basically see their return. It's those high growth venture backed companies that this probably makes the most sense for. And for the investors where this makes sense is it depends on your risk and return profile and what you're comfortable with, your risk tolerance. But it really makes sense if you see that a company has exit potential. So it's not just going to steadily grow and ultimately, it's going to maintain the same ownership structure. But if you think that the company is going to be the next Uber or Airbnb and Lyft, or Lyft or other unicorn that will eventually IPO or get acquired by one of those big tech companies, for example, that's the type of instrument that makes sense there. So that's the type of instrument that we use most often on the platform. But we have two others that we're just starting to use more and more. So both are equity-focused instruments in which investors can actually own a piece of the company, and there's some important differences there. So we have two: the crowd IPA, the interest purchase agreement, and the crowd SPA, the stock purchase agreement. So what the difference is: a crowd IPA is for when you're investing in an LLC, and the crowd SPA is for when you're investing in a C Corp. And for the most part, it's a Delaware LLC or a Delaware C Corp. So a crowd IPA means you're purchasing membership interests in an LLC, and it allows for different classes of membership interests, and there's no certified security instruments issued to members in that LLC. And there's flexible distribution of ownership. The kind of company that is a good fit for this is, for the most part, small businesses that are raising on Republic that aren't necessarily looking for that big exit. So if you're a brewery or you're a CPG company or another food and beverage company, or you have a physical brick and mortar location and you want to give your community upside potential, the crowd IPA would probably make sense because you're probably an LLC. And so that's the kind of company where that makes the most sense. And the investors that make the most sense for this instrument are those that are members of that community and see a potential that owning a membership interest in this LLC is going to lead to potential distributions or payouts from profits. The SPA is very similar to the IPA. It's a stock purchase agreement, which is a C Corp, which is an instrument that's used for a C Corp. And the key terms at the time of the investment are the valuation, which determines the share price, and the rights that you're granted as a shareholder in that company. So then the two most common types of shares are common and preferred stock. And we work with both for different types of companies. So what's a good fit? What kinds of companies are a good fit for the SPA are also startups, but honestly, any kind of business that wants to issue equity to investors and they see upside potential. So as an equity holder, as a shareholder in a company, you have access, depending on the way that depending on the type of share that you own, whether it's common or preferred, or with the way that agreement is written, you either have voting rights or you have interest and dividend rights in the profits for that company. So it's important to know which type of stock purchase agreement you're investing in, and what the company, what the ultimate goal of the company is there. The type of company that this makes sense for is a company that's growing and it either intends to exit or pay dividends to the investor, and they need to raise a lot of capital. The type of investor that this makes sense for is the investor that's looking for at some sort of regular distribution of dividends, and they see a path to the company making those dividends, that you want to be, this is good for investors that want to be true shareholders, not a safe or a convertible note holder, and those that maybe have are looking for a liquidation preference. And a liquidation preference means that depending on how it's written, the investor gets paid out in an exit event or a dissolution first. It's a simplified way of thinking about it, but that can be an important term to some investors. The last convertible or equity focused instrument that I wanted to touch on is the convertible note. So what is a convertible note? It's actually it's very similar to a safe, and a safe is actually a form of a convertible note, except just a simpler version. So a convertible note is short-term debt that converts into equity. There's a valuation cap like we talked about. There's often a discount like we talked about. And then there's one more provision, or two more provisions that are not in the safe or the crowd safe. So for one, there is an interest rate that accrues on the investment over time that the safe doesn't have. And there's a maturity date as well. So the investment automatically converts to equity after a certain amount of time in most cases. So a convertible note makes sense is a more investor-friendly instrument than the safe. But for the purposes of the Republic platform, we don't really use them because there's some tax implications of using a convertible note for investors that make it a little bit less friendly. So we use safes almost exclusively on the platform. But if a company wants to use a convertible note, we can definitely do that on the platform. And then the last instrument that I'm going to talk about is a revenue share. So this is a debt-focused instrument, usually for cash-generating businesses that are approaching profitability or are profitable, and they're looking to have some sort of regular payment to investors. So this often tends to be similar to the profile of a company that is an LLC, and you might have invest using a crowd IPA. And so this is often a small business, has a brick and mortar presence like a brewery or a restaurant or a hotel, and they're looking to pay out a portion of their revenue to investors. And the investor that this makes sense for, it tends to be the one that wants a steady stream of income, that doesn't want to wait for a liquidity event to get higher returns, and that is higher up in the capital stack and gets paid out first in different types of liquidity events. So that's an instrument that we are definitely looking to explore more on Republic, and we're really excited to roll out offerings with that. And then we'll quickly run through some case studies and examples of companies that have or haven't run Republic campaigns and the way those instruments have actually played out in real life. So for one, let's say we have a company that is founded in 2015. About 3 years later, they raise on Republic about $300,000 with the crowd safe and a valuation cap of $5 million. Then they go and raise another equity financing round, a seed plus round, say at a $15 million post-money valuation. What does that mean for Republic investors? So it kind of depends. It's definitely case by case, the way that investors get paid out and how much they're looking to see. And the PDF, I guess, didn't render correctly here, so I apologize. But the short of it is the investors are making they're converting to shares at a significant premium to what they paid for it, which is exciting. So the investors in this company, let's call them Company A, are on the track to make a sizable return in their Republic investment of this company. Let's say we took another case study, Company B. Well, this one's Toptal. It's a freelancing platform that connects businesses with software engineers, designers, and business consultants. They're founded in 2010. They hit $200 million in revenue in 2018 and have an estimated worth of more than $1 billion. They raised seed funding from some top investors like Andreessen Horowitz, the CEO of Quora, a couple Facebook employees, and they used a convertible note for that with a $10 million valuation cap. They decided not to raise any more money, and the entirety of the company is still owned. The stock is actually owned by the CEO. So in that case, the investors didn't see a return because of the specific instrument that we're talking about here, the convertible note. So convertible notes are really only make sense if we see a trigger event or a conversion event happening where the investor converts to equity. And in this case, that instrument actually disadvantaged those investors pretty heavily because they never converted to equity. So that's why it really only makes sense. Convertible notes and safes only really make sense for companies that are going to have a trigger event or an exit. But yeah, so those were basically a run through of the different Republic instruments on our platform and 2 case studies that illustrate how an investor can potentially make a return. And I'll pass it over to Sundeep and Cheryl now to introduce our next panelist.